I'm the broker of Just Global Inc. and host of the Global Real Estate Investor Club. And we are a local real estate broker. We offer opportunities in real estate investment in out of state as well. And today, we're very happy that we've invited Mr. Oscar Wei, who is the Deputy Chief Economist of the California Association of Realtors. He has written many articles and reports on subjects like housing supply, affordability, mortgages and finance, home ownership, tax reform, and other topics related to real estate industry. We now invite Oscar. Oscar, you got the floor.
Thank you, Monica, for the introductions, and thank you, everyone, for being here. I'm very honored to be here, and thank you for the invitation. Now, we do have I do have a PowerPoint that I want to share and want to share with you, about what's going on with the current housing market, what's going on with the California housing market specifically, and of course the South Bay and the Bay Area. Now, of course, for the last, I think, 6 months, 7 months, or maybe actually about a year or so, we have been seeing some ups and downs in the market. And during the pandemic era, we have been seeing increase in home in sales and price, and it continued to go up partly because of interest rates actually remaining at a low level. But of course, we have seen interest rates rising due to inflation in the past 9 months, a year or so. And of course, it's going to continue on in the upcoming year in 2023, possibly in 2024 as well. So what can we expect, with that kind of an environment? And what about, the economy as well? The economy, because of high interest rates, probably will slow down a little bit. So let's take a look at, in the next 45 to 50 minutes or so, let's take a look at what we can infer from all these information, all these situations in the market. Actually, give me 1 second. I actually started with not the very first slide. So bear with me for a second. Let me start with the very first slide first. Here we go. I apologize for the inconvenience. Bear with me. Let's get started again. Here we go. So there are a lot of questions, of course, about what's going on with the economy, what's going on with the market, and where are we heading right now. And first of all, I have to apologize for not being able to show my face. My camera, for some reason, didn't work. And so I hopefully, the PowerPoint presentation is perfectly okay. But I think most of the time you'll be looking at the slides as well. And there's a lot of stuff on here. And Monica, feel free to share the slides afterwards. And I think it has a lot of information that we may not be able to actually spend too much time on every single slide, but feel free to share the slides. Now, as I mentioned, here's the big picture. There are a lot of things to cover. First, at the next 10 minutes, 15 minutes or so, let's take a look at the big picture. Let's take a look at what actually could happen with inflation, with the economy possibly getting into a recession in 2023. And of course, the other big question is about interest rates. Interest rates have been rising pretty rapidly in the last 12 months or so. Right now, interest rate is average is probably around 650, 660 for the 30-year fixed rate. And that actually has some impact on the housing market for sure. And of course, with that interest rate at a high level, we have been seeing sales actually declining, residential sales actually declining quite rapidly in the last 6 months or so. Prices have been, started getting a little bit impacted by the loss in demand, but I'll tell you in the last sections where we will be heading with that prices. And of course, when we put everything together, I will tell you that it seems like, despite the fact that we actually have been seeing some decline in sales, we actually might have seen the bottom already. Recent statistics, recent sales numbers that we collect on a weekly, on a monthly basis seem to suggest that things actually are improving. Now, when I say improve, it's still a long way to go, obviously, but things are actually slowly getting back to slowly improving, slightly still pretty depressed as far as sales are concerned, but we're moving into the home buying season in March and April, and hopefully things will continue to improve as interest rate continue to stabilize. Price-wise, I think we still haven't found a bottom yet, but in the next couple months or so, very likely that we may hit the trough and actually be climbing up again in April or May or so. It will still show a year-over-year decline in terms of price, but we actually may be off the bottom and continue to climb. Now, different areas might be a little different, so I'll talk about regional and some local stuff as well. Obviously, with prices continue to stay at a somewhat elevated level, we probably will have some affordability issues appearing in 2023 and 2024. So let's get started. Let's take a look at some of the economic and inflationary number first. Now, I know it's right around lunch. I'm showing a lot of food, so bear with me. And right after this, you can go to lunch. But what I want to show here is, inflation numbers from food prices. Take a look at this chart right here. I have a graph, and on the side of the graph, of course, I have some items, some food items here. You can see on this chart, on this slide, I showed two different prices for each item. One is the price in December 2020, and the other price in December 2022, a 2-year difference in terms of price. Take a look at prices for eggs, for example. It jumped from $1.48 per dozen to $4.25. Significant increase in eggs. And of course, in the last few weeks or so, there have been a lot of talks about egg prices or so. Now, regardless of what the reason why egg prices have gone up, the prices have gone up quite significantly. Now, there are other prices, for example, chicken and ground beef, milk, they have all increased in prices. And so safe to say, when we talk about inflation, we're talking about, increase in prices overall, not just for food, but also for energy prices. Many of you probably have been at a gas station, maybe even this morning. I may have seen a few months ago, $8 or even $9 a gallon of gas prices at the gas pump. And of course, recently it started coming back down to a more reasonable level, maybe $4, $5 or so. So prices actually have been, it had been rising, but recently it started actually coming back down. With inflation, seems to be actually a little bit more in control. Now, at the highest point, I think it's in June or July earlier last year, we actually hit an inflation rate of 9.1%. If you take a look at this peak right here, that's the 9.1% peak in July, meaning on a year-over-year basis, we saw actually an increase in consumer prices by 9.1%. Now, to put things into perspective, before the pandemic, we actually had about 2.5% consistently for about 10 years, and then it started rising because of energy prices increasing, but also because of some of the protocols that we have implemented during the pandemic might have actually pushed some of the prices, tightened up some of the manufacturing activities, leading to maybe fewer items being put on the shelf, and that caused some supply and demand issue, just like the housing market, that push up prices overall, and that's why we have been experiencing inflationary pressure. Now, if you look at this blue line right here, this dark blue line right here, it is actually declining. Currently, the latest number that we saw yesterday was the January CPI number, the Consumer Price Index number. It suggests that inflation actually has come down to 6.4%. Now, some improvement, that's great. But of course, it's still higher than the 2.5% that I mentioned earlier. It's going to take some time, and I'll show you towards the end how soon we're going to get back to that level. At the same time, the Federal Reserve, the central bank of the U.S., have been trying to control inflation by raising rates. Take a look at the column right in the middle where it says rate change. The Federal Reserve, the central bank, has been raising rates many times, 7 or 8 times in the last year and 12 months, 13 months or so. They started in March with only 25 basis points at first, and then they continued to control inflation by raising Fed funds rate by 50 basis points, and then 4 times by 75 basis points. And recently, they started easing off a little bit, not being so as aggressive. The latest time that they increased the Fed funds rate was February 1st, and they will meet again in March to determine whether they will need to add another rate change. Now, the latest rate change or the rate hike that they did was in February 1st, and they raised it by 25 basis points. And the target range, the Fed funds target range right here is 450 and 475. Now, again, to put things into perspective, I know it's a little hard to grasp, how that relate to the 30-year fixed rate sometime. Typically, historically, using historical average, the spread between the 30-year fixed rate and a 10-year bond or Fed funds rate could be about 180 basis point, 200 basis point or so. And today, the 30-year fixed rate mortgage is roughly around 650, 660 or so, depending on what source you look at. Some source, when you look at those numbers, it could be a little bit higher, 660, 675. And I think the Freddie Mac's number will be releasing tomorrow, and so we will see another set of number. But safe to say, the Federal Reserve has some power on determining where interest rates level is. Now, not necessarily when they raise rates, it doesn't necessarily means that interest rates will go up. It's usually the other way around. The market anticipate what's going to happen with the overall bond market, what's going to happen to the interest rate environment, and they work accordingly. So usually rates are the 30-year fixed rates or so. They're usually predicted by the market try to predict what's going on with the Fed funds rate and the overall interest rate environment, and then they go from there. Now that's why this chart that I'm showing you, it shows some probability, some odds of what is going to happen in the upcoming March or maybe the May meeting. A lot of people like to find out what is going to happen with the next upcoming meeting, and then that will determine what the rates probably will look like, rate environment will look like in the next 2-3 months or so. So if the predictions turn out to be right on, then of course there might not be surprises with the interest rate movements, and they will probably stay somewhat stabilized at maybe about 650. Now, if it turns out the inflationary condition is actually a little bit more positive, then rates will not be raised as much, and so interest rates overall will eventually come back down. So let's take a look at those probability. Now, I have the probability of the odds or the probability for the March meeting, which is their next meeting, and the probability of how many percentages they will raise in May as well. So two meetings going forward. So a lot of people, if you look at the latest predictions that I have for February 14th that was done yesterday, there's an 88% chance that the Fed funds rate will be raised to the range of 475 to 500. Now, remember what I showed you earlier, the range was at 450 to 475. So if this actually turned out to be the case, that means the Federal Reserve will raise rate by 25 basis point. And there's an 88% chance that they will do that. The other 12% chance, they will actually raise rates by a little bit higher, by 50 basis point. So that number actually changed over time. And you can see 2 months ago in December, there was only a 55% chance that the rate will actually hit the 475 to 500. That was because inflationary conditions was actually a little bit more optimistic towards the side that the Federal Reserve will not be as aggressive. But as we start seeing a little bit more information about inflation, people started realizing that okay, that 25 basis point increase is a lot more likely. And the same thing for May. With a more likelihood of rates going to 475 or raising by 25 basis point, the meeting after that means it probably could be, unless there's a rate cut, it probably will be higher than 475 and 500. And in fact, 74% chance that it will actually be another 25 basis point, and it will reach the target range of 500 to 525. So I do believe that this is pretty consistent with what we have been predicting at CAR. 25 basis point in the March meeting, another 25 basis point in May, and whether there is going to be another 25 basis point the meeting after that, that's really hard to say, because there's a lot. We will have a lot of data to kind of review before deciding what's going to happen. Now, there are some other things that happen as well that could affect, the inflationary picture as well as the economy. Take a look at this chart that just released this morning. The retail sales number were just released this morning. It shows that released the January 2023 retail sales number, and it shows, if you look at the first section right here, retail sales, the very first line, it shows that January 2023 there was actually a 3% gain in retail sales activity from the month before, and on a year-over-year basis, a 6.4% increase. That's pretty significant. Now, of course, you have to take this with a grain of salt. Also, the very first sections up there actually does not account for inflation. If you account for inflation, the number actually is a little bit smaller. What is that number? If you look at the last section, real retail sales number, month over month, that's the number estimated accounting for inflationary pressure. So with inflation accounted for, we are actually increasing by 2.6% for the month-to-month, and on a year-over-year basis, about 1.9%. Now, this report actually is somewhat encouraging because the prior month in December, towards the end of the year, we actually experienced a decline in economic activity, which suggests that things actually could be going into the negative directions for the economy, which means we might actually see a recession. But real retail sales actually bounced back with the highest level for going back to, I think, May 2021. So this is encouraging in the sense that consumers are still spending, consumers are still staying okay. Now, of course, there are different items within this report, within this retail sales report, that suggest that overall, now I think what's actually pushed retail sales to a very high level is the strong surge in auto sales. But when we took out, the auto sales number, other retail sales numbers suggest that things are doing okay. So the reason why things are actually doing okay probably has something to do with the labor market. We have heard about, in the Bay Area, there were a lot of tech companies. There are currently a lot of tech companies that's laying people off, but they're actually taking primarily, the news focus on many of the tech companies. So, from the perspective in the Bay Area, it seems like, things are actually not moving forward as smooth as things should look like when the economy is actually doing okay. But for the U.S. as a whole, job growth actually has been doing okay. Now, part of the reason is, in addition to the tech companies, there are other sectors that are doing okay. If you look at the job growth for the first month of the year, it actually shows that jobs increased by 517,000 on the non-farm payrolls. That actually surprised a lot of people, surprised a lot of economists, because we have been seeing some solid growth in jobs, but they have been around 200,000, and it has been declining. Take a look at these bars right here. They have been declining for the last few months or so, and all of a sudden, at the beginning of this year, it surged, and that surprised a lot of people. That also suggests that maybe the labor market is stronger than what we thought. Again, like I said, in the Bay Area, we might be seeing a little bit more job decline. But for the state of California, I think we're actually holding on okay, partly because of the travel industry doing okay, service sectors doing a little bit better. But of course, I think in the Bay Area, you're actually feeling a little bit more when you look at home prices, when you look at some of the things that might actually be declining a little faster compared to the state as a whole. Now, I'll talk more about that in a minute. But job growth as a whole for the whole country and for the whole state seems to be holding on okay. Now, that actually concerns a lot of people at first, because strong job growth means we might actually see more inflation, because there are not enough people in the market who offered the labor skills, and that's why we have been having more demand for jobs than supply, and that actually push up wages. push wage growth to a higher level, and that would actually lead to higher inflation. But if you take a look at the same report, it actually suggests that wage growth actually continued to slow down a little bit. It's growing at 4.4%. If you look at this chart right here, it's growing at 4.4% right now, and it's definitely lower than the 4.8% that we experienced at the end of last year. So in a way, it actually suggests something that might be some good news in the sense that the economy and the labor market actually is doing better than we thought, and inflation actually has been coming down. Maybe not as fast as we were hoping, but it's actually coming down. And it actually, some of the numbers, of course, in addition to the strong labor market report, also suggest that, depending on whose perspective you look at, some economists or someone in the market and the financial market may think that, well, even 4.4%, it's still stronger than what we expect. There is a consensus out there. Wall Street Journal or some other entity actually put together some numbers, some surveys, and they were hoping, some economists may be hoping for a lower number, like a 4.2% wage growth. So a 4.4, even though it's declining, is still a little higher compared to someone's expectation. So that's why we are seeing some volatility in the financial market. Now, what about the housing market? We'll go back to the economy later this part of the section. But what about the housing market? The housing market, of course, rely a lot on interest rates, but also the sentiment also count. People are looking at the interest rates level, but also they're concerned about, what's going to happen with the housing market. Are we seeing a slowdown in terms of price, in terms of sales? So some of the statistics are being captured. Some of these statistics are being captured by Fannie Mae. Fannie Mae put together a home purchase sentiment survey every month. Here's one chart that the survey sentiment actually put out. It's a buyer sentiment, and I'll show you in a minute the seller sentiment as well. The buyer sentiment, this question is very simple. It asks whether it is a good time to buy or it is a bad time to buy. Let's focus on that blue line right here, the blue dotted line right here. It does show that, maybe at the beginning of 2020, 59% believe that we were in a good time to buy, but that number continued to decline because of increasing home prices, because of interest rates in the last 12 months or so. That number actually dipped to 17% lately. Now, so it continues to soften up a little bit, especially since there's some uncertainty about the market. Good time to buy actually dipped to 17%. So that's one of the reasons why we're seeing fewer home sales in the last 12 months or so. Now, at the same time, what about sellers? Sellers are also feeling not as motivated as before, but it's actually better than the buyer sentiment. If you look at, again, the blue line right here, the blue dotted line right here, it was at 69%. It fluctuated a little bit. It actually dipped, continued to decline to 51%. But lately, in the last maybe month or so, the number actually started going back up again, offering some hope that maybe things would be getting a little bit better. Now, sellers, of course, are concerned about how fast your house can be sold, and also, of course, the price that they can get. It looks like prices are not, depending on which areas you're in, the prices are slipping a little bit, but some areas are doing better than others. And overall, I think right now California actually dipped about 2% on a month-to-month basis. But compared to the peak price level, we might be a little bit further than that. I'll explain a little bit more later. Now, with those sentiments, of course, as I mentioned, both buyers and sellers, they actually have been looking at mortgage rates. Now, mortgage rates, if you look at this blue line right here, you can see there are definitely some fluctuation. We used to have rates about a year ago below 4%, and at one point it was below 3%. But take a look at rates right now. The rates right now, right here, it is currently, if I remember correctly, yesterday was somewhere around 660 or so, a little bit more than 652. I think it increased again because of concern about what's going to happen with inflation and what the Federal Reserve will do. And so you can see the last few weeks or so, we are seeing some uptick. But at one point it did go down to 6% or so. But before then, in October or early November, we did have mortgage rates going all the way up to 7%. Now, fortunately and hopefully, we won't see that 7% again because inflation started coming back down. But with a 6 or 7% interest rates, you can understand why some of the consumers or some of the buyers are concerned. Now, I only have data through December because we are releasing our January's numbers tomorrow. So I apologize for not having all the latest number, but the story is still the same. If you look at, the high rates of high mortgage rates combined with high home prices, your mortgage payments for someone to buy a median price home or typical home, it continued to stay at a higher level compared to last year. If someone were to buy the exact same home this year compared to last year, their mortgage payment actually will increase by close to 42%, even though that number has already come down. It used to be a much higher number at 55%. The number has come down to 42%. Now, I looked at the January's numbers that we will be releasing tomorrow. The number actually dropped below 40. So that's encouraging in the sense that we are seeing mortgage payment growth actually slowing down, which means things will be a little bit more affordable for buyers. But on the flip side of the coin, take a look, it's still about 40% or 30%, if you want to look at the January number. So it's still a big amount. 40% means people will have to pay maybe about $1,000 more every month on their mortgage in order to qualify to buy a home. So that might be one of the reasons why we're seeing some slowdown in demand. And here's the demand at the end of last year. In December, we actually dropped about 44% in sales. For the year as a whole, about 23.1%. So definitely, yes, we have been seeing some significant decline in sales in existing home sales in the at the end of last year. Price also started dipping, but at a more moderate level at 2.8% or 3% or so. Now, it's true. We have been doing. I'm not sugar. It will be hard for me to sugarcoat it. We are seeing fewer sales at the end of last year. But what I can tell you is, it looks like in December, the pace of sales decline started actually improving. In fact, looking at the January's numbers that I was discussing with some of my colleagues earlier today, it looks like will continue to decline on a year-over-year basis, but that decline actually will be smaller and possibly even smaller in February and March as we move into the home buying season. So things are improving, but at a very slow pace, though. If you look at the sales decline, as I mentioned, this is this was what I was talking about. We might have bottomed out, in November, and as we move into December and January, of course, things will improve. Now, of course, this is a slide based on state number. Different regions also could have different outcome. And higher price segments in general in the last few months actually have been declining a little faster. Part of the reason that could be the case could be, as I mentioned earlier, there might be a little bit more tech companies laying people off. And so the sales figures in the Bay Area or some of the higher end areas could be a little bit softer compared to before. But it also could mean that the sales trend could be a little faster in terms of the decline, but it actually could recover a little bit sooner, depending on, of course, the economic situation. So going back, you can see comparing June of last year versus the end of last year, you can definitely see more significant decline in some of the higher price segments, and hopefully we will actually see some bottoming. In general, the overall market has already bottomed out, but different segments may be a little bit different. What about price growth? Now, of course, with demand declining, we also expect prices to soften up a little bit, and we have been seeing some price growth softening in the last probably 8 or 9 months or so, to the point where single family actually started declining by 1 or 2%. Now, from the peak, and you hear that from media, from reports from time to time, from peak to trough, how much we will be dipping. I think Goldman Sachs released a report. Some of the investment company may have released a report that says, in certain areas, and I think some cities in Bay Area could actually dip by about 20-25%. Now the peak, of course, you have to actually really understand what exactly they mean by peak to trough. The peak, as I mentioned, actually happened in about May, maybe even earlier for the Bay Area, maybe in April of last year or so. So prices actually have been slipping, month-to-month basis since then. And some cities might have already dropped by about 20% already. So another 5% is very possible, but that also means that in the next couple months or so, we probably will see some bottoming out of prices as well. Now, sales, I said, we might have already bottomed out, but price, we might have actually seen some bottoming out. So comparing the trough, which could hit, in the next 2 months or so, before the spring home buying season start picking up, which I believe we probably will, then the difference between the peak and trough could be about 20% and 25%, depending on what areas you're in. But the good thing is we might actually see, prices started improving a little bit as we move into April and May. Of course, these are all speculation based on interest rates movement, based on inflationary pressure that we're seeing right now. But it looks like, we are seeing inflation easing a little bit. Now, the other part of it, of course, that might affect sales and price are, the active listings, how much inventory we have, how much supply we have in the system. And many of you already know active listings continue to stay very tight. Now, this chart shows you that we have been seeing some improvement in active listings and inventory. Well, on the surface, yes. But part of that 82.4% that I'm showing here, that's partly part of it is because of the pullback in demand. In fact, a big part of it has to do with the big pullback in demand. We dropped by about 40%, 45% in sales. A lot of those listings that used to sell in like 8 days or 5 days or so get carried over to the next month, and that's why we have a bit more inventory. If you want to really look at the supply situation, you should look at the new listings being added every month. Take a look at the new added listings. Take a look at the blue bar chart right here. You can see the blue bars actually have been declining. In fact, in December, the number actually dropped to the lowest level for at least the last 5 years. I looked at the January's number. That number actually improved and bounced back, and that's typical because seasonally we typically see maybe a 30-40% increase from December to January, but the numbers still stay at a very low level. It was still declining in January by about a double-digit 16% or so. Now, on the negative side, fewer listings means we might actually have fewer sales because there are less properties to choose from. But on the other hand, it is actually providing some support to the home prices, and that's why home prices have not been declining as severely as what we saw maybe in about 15 years ago during the recessions. And we will talk more about that shortly. Now, the one reason why people may not be actually putting their house up on the market and keeping the supply very, very low is because of the lock-in effect. Take a look at this chart. This is the portfolio, basically a portfolio of Freddie Mac. What kind of mortgages they're holding right now, and it shows the type of mortgages with the interest rate range or mortgage rate range. 20% of the Freddie Mac's portfolio actually has a mortgage rates of between 2 and 2.99 or 3%, and about 63% have the mortgage rates at around 3 to 4, and another 16% between 4 to 4.99. So if you look at that pie chart right there, if you add up this chart, this pie, and this pie, you see a 99%. A lot of people, that means 99% of what the Freddie Mac hold on to, they are below 5%. And that's the reason why people may not want to sell their property right now, because if they were to sell a property and buy another one or trade up or trade down, that means they will have to lock in at a little higher rate. I said it earlier, 6.5% or so, which actually will cost them more if they were to trade up or trade down. And that's the reason why people may be holding off. And so interest rates, that's why interest rates play an important role, because when interest rates start coming back down to a lower level, a more affordable level, that will actually help buyers to be able to get into a house, but at the same time also allow current homeowners to free up their properties and move to another place or move to another property. That might actually take some time. I'll give you some idea later on, how much that will take. Let's quickly look at some regional numbers. As I mentioned, state number in Bay Area may look a little different, but let's take a look at the Bay Area number. At the end of last year, on a year-to-date basis, so for the year as a whole for 2022, it actually dropped close to 26%. And you can see that things actually sort of sped up a little bit at the end of last year, dropping a little bit more. Hopefully, that number continued to dwindle. When I look at the January 2022 number, it looks like the number of the percent of decline actually dropped to maybe about 36%. So we're seeing some improvement. But in the meantime, we also see in the Bay Area, prices actually have been dipping a little faster. The Bay Area, as a 9 Bay Area region, actually dropped by about 9.6%. They actually are dropping a little faster. Prices are actually dropping a little faster, a little sooner or earlier than the state as a whole. The state just started about 3% dropping by 3 months ago, but Bay Area might have dropped a little sooner, partly because of you already know the things that I mentioned, because of the tech companies getting laid off, many people getting laid off in the tech companies. What about the stock market? Stock market has been fluctuating towards the end of in the second half of last year. It seems to be improving a little bit in the first few weeks of this year, but there are still ups and downs. But the drop off in stocks might have actually caused some people to decide to sell or not able to buy. So that wealth effect, started feeling, I'm less wealthy because I don't actually have as much money as before because I'm losing money in the stock market, might have prompted people to hold off. And that's why sales actually have been slowing down a little bit. I believe that's part of it. But as I mentioned, state actually have been, might have bottomed out. And I think Bay Area also may have bottomed out, and if not, very, very close to bottoming out. Take a look at this right here. I know it has been increasing and then decreasing and then showing another, increase again. This might actually be it. Depending on how interest rates may behave, from this point on, we may actually start seeing some improvement in terms of year-over-year change. Now, we're not going to go back to 0% or actually positive quite yet. It will take a few months at least. It might actually take a little longer, but at least we're seeing smaller decline, and hopefully things will actually get a little bit better. Now let's look at the 9 counties in the Bay Area. I highlighted Santa Clara specifically because I think that's what we want to focus on. And if you look at Santa Clara on a year-over-year basis, if you look at this column right here, you can see obviously there have been some significant decline. At the end of last year, we were dropping by about 43%. On a year-to-date basis, about 29%. So for the year of 2022, it dropped a little less, partly because of how strong the very first few months have been. First few months were. But at the end of the year, we started dipping a little bit, and it probably will continue to dip a little longer, maybe for the next couple months or so. Or actually, let me pick that back. On a month-to-month basis, it will probably bottom out in, let's say, March or April or so, depending on whether there are any additional layoffs, and whether the economy will continue to sustain growth. And if the economy can sustain, economic growth, then we may actually pick back up a little faster. But on a year-over-year basis, you may actually still see a decline in sales, because let's face it, compared to a year ago, at 3 or 4%, it's a little tougher to get into a home right now. So on a month-to-month basis, I think we will start climbing though. It's going to be a slow climb, and it's going to take some time. What about prices? Prices also started declining on a year-over-year basis and on a month-to-month basis. As I mentioned, at the Bay Area, they're declining a little faster compared to other part of the state because of those reasons that I mentioned earlier. And in the Santa Clara County, year-over-year, it actually dropped 15%. In the next couple months or so, we may actually see some higher year-over-year percent change, but I think, again, by March, April or so, the month-to-month percent change probably will start actually slowing down, maybe even improving a little bit, maybe in June or so. But from that point on, things actually might level off a little bit first before going back to increase. Now, the other part of it that you probably should keep in mind, keep your mind on, is this is the median price. This is the price right in the middle. We have been all over the state, not just in the Bay Area, we have been selling fewer high-end homes, as I mentioned earlier. But in the Bay Area, there might be some more high-end homes not being sold, and that actually affect the median price because now you're actually seeing more affordable properties being sold. That might actually tend to pull the median price down a little bit. So if that when that happens, that suggests to me that yes, prices may decline, or median price may have declined, but it's not just about price depreciation. It is also because of mix of sales. I typically, when I did my calculation with how much actually should be assessed to mix of sales and how much decline should be attributed to price price depreciation, usually it's half and half. So if you see a 15% decline, for example, that means maybe about 7% of those could be attributed to mix of sales, not necessarily because of real actual decline. So the actual decline most likely is a little bit less. But at the same time, when you make assessment on the price growth, you also need to make that distinction as well. Now, for Santa Clara, with high prices at over $1 million for median price home, the housing affordability, which is the number of people who can afford to buy a median price home, actually remain at a low level at 20%. Let me brief through this market update, local market update. I can tell you later on, where to get some of the additional cities if you're interested. The local housing market basically is a one-pager. I listed about, I think, 14, 15 slides here. I'm going to brief through them because they tell a similar story. Prices for certain city remain, and at the end of for the year as a whole for 2022, remain at a decent level, even show a growth. But at the end of the year, they started dipping also. I'm showing you the entire year number because it has more information. It gives you a brief overview of what's going on. Basically, sales continue to decline in every single city. Prices for the year as a whole continue to improve. And of course, active listings appear to be improving, but new listings actually decline. So Campbell is showing a similar story like what I told you. Cupertino, a slight increase in price, and home sales actually dipped quite a bit, close to 40%. Price also increased in Gilroy for the year as a whole. Again, for active listings, it actually increased by 40%, and home sales actually dipped by about 30%. Los Altos, very similar story, but the growth actually for the year is actually smaller. Home sales actually dip about 30% or so. Skittles, about 5.3% increase in median price, and sales actually dropped 37%. And median price for Milpitas seems a little bit higher the more affordable the homes is. So with 1.5 million, the median price actually increased a little bit more compared to a couple of the cities that I showed earlier. Morgan Hills, also about 13.2% for the year as a whole, with active listings increasing. Now, the items at the very bottom, those are market competitive indicators. Many of you are familiar with them. Days on market, sales price to list price ratio, and then percent of active listings with the reduced price. Those also will indicate, how competitive the market is. Mountain View, also close to 10% increase in price. Home sales dropping by 33%. Palo Alto, 2.8% increase in price and a drop of 31% in sales. San Jose, 12.5% in price, and home sales dropped close to 28%. I think this might be the last one for local. Santa Clara actually increased by 12.1%. Santa Clara, city of Santa Clara, and a 20% decline in home sales. No, maybe not. This one actually is the last one. Saratoga, 8.5% increase in price and 41%. Oh, I'm still missing one more. 10.6 in Sunnyvale and a 20% decline or 21% decline in home sales. So those are the current market conditions. What can we expect in the upcoming year and maybe 2024? Now, again, the question is about inflation. Let's take a look at inflation. These charts on the right-hand side, these bar charts on the right-hand side, or the left-hand side, I should say, gives you some idea of First, the blue bars meaning suggest what the actual numbers were that were collected, and the red bars gives you an idea of where things could actually end up in 2023 and 2024. Now, the fourth quarter of last year, CPI number and the inflation number suggest that we actually increased by 7.1% in that quarter compared to the year ago. And it looks like from that point on, things are actually going to decline. In fact, UCLA predicted this at the end of 2023, we will see a 2.8% CPI or inflation number, which is pretty encouraging. And by the end of 2024, we actually will see a below 2%, only a 1.8% increase in the inflation rate, which is in line with what we had before the pandemic, which is good. But at the same time, we know that the Fed will have to do a lot of things. This dot plot chart is a chart that shows the opinion of individual Federal Reserve official. They cast their vote and they provide some information about the year end, where things are going to be. So at the year end of 2022, we'll have the actual numbers already. It was close to 4.5 for the upper end. And that number actually will increase to around 5.25 or so. So safe to say, we will see a higher rates at the end of this year compared to last year. But from that point on, 2024 and 2025, most likely things are going to come down and actually see a slowdown in interest rates. And if that actually pan out to be the case, 30-year fixed rates also should be coming back down. And the reason why we are optimistic about the inflation number is because the supply chain actually has been improving. Supply chain, this is a number that shows the global supply chain pressure index. Anytime it is above this zero line, that means we have more supply pressure. And you can see that at one point we were very, very high, but it's actually coming down. It continued to come down. It may actually take a little bit more time to come back to the zero line, but it's coming down. So it's actually something that's encouraging. But what about the kind of confidence level of some of the households, consumers? If they're actually not feeling as confident about the economy or the financial market, then they may actually not be spending as much. But if you look at the latest survey from the New York Fed, take a look at when you look at the blue bars and the orange bar, when you add that together, that means people believe that they are going to be worse off compared to 12 months from now. And yes, we still have quite a few people who actually believe that they will be worse off financially, but that number suggests that the chart here suggests that we are actually coming back down, which is encouraging. The bottom line is still about economy. It's still about whether we will expect economy to continue to grow. Last quarter, the very last quarter of 2022, we actually had a 2.9% decline increase. Pretty decent, but not as solid as a few quarters ago. But the question is whether that will continue in the upcoming year. Now, I have to be realistic. If you look at the saving rates, fewer people are saving right now. In fact, significantly lower than when we were in the pandemic because nobody was spending, but even more below the pre-pandemic level. So with less people saving, we're not going to have as much money to spend, especially for the household with low income. More people are actually spending more of their income on than what they're earning. So they have to cut back. People will have to cut back. And in another survey, consumers, they do plan on spending less. Even though they previously said they will be spending about 8 or 9% more from 12 months from now, fewer people are saying they will be actually spending less, maybe about 6% more than just 12 months from now, lower than the 8 or 9% that I mentioned earlier. The other part of it is the business investment or business leaders' confidence about the economy. CEOs matters in terms of how much money they want to invest in their company and how much money they want to spend on hiring people. Take a look at the confidence level. This is the confidence level for CEOs. They have been declining, but the latest quarterly survey suggests that they're actually feeling a little bit more optimistic. In fact, if you look at the number of people who believe the economy will be going into recessions. The numbers stay pretty much the same. 86% believe that we are going into a brief or shallow recessions in the next 12 to 8 months, a little bit higher, in fact, compared to the last quarter. But look at the number of people who believe we will get into deep recessions, drop from 13% to 7%. So things are actually improving. Still, people believe that we're going into recessions, but fewer people think it's going to be as severe. Now, I have a couple minutes to wrap it up. First, let me show you the economic outlook. Take a look at the economy. In the last column right here, 2023, we forecast that there is going to be a recession, and that's why you're seeing a negative 0.5% decline in GDP. At the same time, take a look at CPI. CPI is the inflation number. We do believe that the inflationary number will actually drop from 8% to 4.4%, a little bit more improvement in the upcoming year. California, typically California is a little bit stronger, but of course, tech sector may actually pull the economy down a little bit, but we have the service sector, we have the travel sectors that should help alleviate some of those issues. So non-farm job growth will continue to improve. California unemployment rate will actually inched up a little bit to 4.7%. What about the market? The market, first, let's look at sentiment. Again, if consumers believe the prices are going to go down, which many of them believe that is the case, if you look at the average expected percent change in price, they do believe that prices are going to go down. But the good thing is their expectation is that the prices are not going to go down as much. Now, this is a national number, obviously. So there will be some differences between this number and the CA number and the Bay Area number. So consumers' expectations of prices probably will delay their home purchases, unless, of course, they think interest rates will actually start going back up. But some people, of course, still believe that interest rates will actually go down in the next 12 months or so. And if that is the case, that means probably more people will be holding off on sales and holding off on buying their properties until a little later. So sales could remain slow for a little bit of time. And interest rates, I can tell you that most likely will be actually right now at 6.6 or 6.5 for 30-year fixed rate. Most likely, it may actually inch up a little bit more before coming back down. Now, I don't believe that we will hit 7% again, partly because I think inflation, even though it is still a long way to go, we probably will continue to slow down. So I think 6.5% will sort of prevail in the next few months or so, and then it will probably start coming back down to closer to 6 or 6.25. Obviously, with that high level of interest rates, mortgage applications continue to dip. If you look at the blue bars right here, those blue bars have been below those other years' level. So we will continue to see some slow sales, but mortgage rates, after dipping below 6% before continue to bounce back again. I don't think, again, it will actually go up so much. Hopefully, it will come down a little bit, and maybe in a few weeks or so. But it all depends on all the reports on inflation that we will be seeing. I do think that strong labor market report probably is a one-time thing. From this point on, we might have a slower job growth in upcoming month in February and in March. Now, someone asked me also, the market is slowing down a little bit. Are we seeing a lot of supply going into the market? Because last time in 2008 and 2009, when the market slowed down again, a lot of supply flooded the market because of REO and short sales. This time it's a little different. Fewer people are putting 0% down payment. In fact, last housing cycle, 21% actually used zero down payment in 2006 compared to 3% in 2022 and some of the lower percentage in the last few years. So people are taking less risk. More people have equity in their house. And that's why we're not seeing a flood of property. Another measure is the negative equity measure published by CoreLogic. CoreLogic suggests that in California, only 0.8% of the mortgages are underwater. during the 2008-2009 era, we actually had about 30% of mortgages underwater. So that's a little different compared to now. Now here's the outlook that CAR put out. We do believe that, you know, as far as sales are concerned, in 2023, we are going to see a drop of 7.2%. Price-wise, some of it has to do with mix of sales change, as I mentioned, but we do believe that we will have some softening in price, and for the year of 2023, and it will drop by 9%. Now for the Bay Area, South Bay Area, probably we will see a little bit bigger drop in 2023 compared to the state as a whole. And the reason why that is the case is we did observe a higher increase in price in 2020 and 2021. So that's why some of the drop could be attributed to higher growth in early part of the last 2 years. Here's the concluding remark. Sales, as I mentioned, most likely will remain weak as the economic uncertainty as well as the market uncertainty remains, and so affordability challenges will persist. As long as those, you know, continue to persist, we probably will have some slow housing demand throughout the year. Also, add on to it is the supply effect, lock-in effect due to rates staying at a high level, and that actually lock up some of the supply, and that's why we will continue to have low level of supply, which will keep prices from falling too fast. But unfortunately, we'll probably see some slowdown in price in 2023, possibly in 2024, depending on the area that you're in. And inflation should be improving. As I mentioned, UCLA predicted that it will actually hit below 3%. So hopefully that is the case. But rates will continue to stay at a high level. Most likely it will not drop below 6% until maybe towards the end of the year. Even if it dropped below 6%, it may actually stay in a high fives for a little longer. And of course, this is the time when buyers and sellers needs a lot of help from realtors. So I think with all the knowledge and all the expertise that you guys have, definitely could help, you know, buyers and sellers understand a little bit more about the market as well as the economy. With that said, I am done, and I hopefully have some time for Q&A. I'll pass it on back to Monica.
Thank you very much, Oscar. That's very informative. Really appreciate all the time taken to prepare this. So I do have a couple of questions, and I also welcome the attendees to type in the question in the chat box. We do have a couple of minutes. So you mentioned a lot about the data for resale homes. So how about the construction, the new construction? Say, being that like we learned that with a high inflation, the construction costs as well as labor costs have gone up quite a bit. How does it impact the market of new build? And also, do you have any stat about like building permits supplied?
Yeah, well, we do have. I have a slide not in here about, you know, permits and multifamily permits as well as single family permits. Now, in the last 10 years, 15 years or so, after the recessions of in 2008 or 2009, we actually have been building less as far as, you know, buildings is concerned, both in the multifamily sectors as well as the single family sectors. Single family sectors started rising a little bit in 2020. It was going to rise in 2021, but of course, 2020 and 2021, it was going to rise a little bit more in 2022, and of course, and then at that time, interest rate hit, and of course, we started seeing some slowdown in sales and as far as price. So that actually kind of deter the builders and developers a little bit, and they actually move over to multifamily sectors. In 2022, we saw a lot of multifamily homes being built because the rental market started actually booming a little bit. In the Bay Area, you probably have already seen. In the South Bay areas, probably have seen a lot of people, a lot of the rental market. Average rent, for example, probably increased by about 8 or 9%, maybe even 10%, 15% in 2022. But because of the supply that we have been seeing, or more builders building multifamily homes in 2022, we will be seeing more of those units, apartments units coming onto the market in 2023, and it will actually lead to slower growth in rent. And so, you know, that sector, multifamily, as far as builders are concerned, that actually is slowing down as well. So in 2023, we will see probably many of the builders, developers holding a wait and see strategy and see how things actually have been panning out. Now, one thing that's working out for not only buyers and sellers, but also builders, the interest rates environment. It does look like inflation is calming down a little bit, even though it's still high. It is actually calming down a little bit. So that might be time to actually look at, whether the cost of building actually will continue to go up. But again, it's not just about materials. It's also about, labor costs. Labor costs also is slowing down, but it's probably not fast enough from the standpoint of builders and from the standpoint of Federal Reserve. But of course, for workers and people who work in industry, they probably want to have a higher wage growth. So we'll see how that pan out, depending on the economy and depending on how things actually are back to normal.
Yes, yeah, that's a very, very comprehensive answer, because we do see that some of the builders, if they have like standing inventory, they are now more open to negotiate price, and also they can provide incentives for buying down
Absolutely.
interest rate to help the buyers to get better mortgage interest.
Absolutely. And
And
we saw that
yes,
actually from our survey as well, that those are some of the incentives. I don't have a percentage in front of me, but that's one of the strategies that builders and developers actually have been offering to buyers and sellers, or buyers.
yes. So from your slide, I read that like 86% of the people, they are thinking about recession. We're going to go into a short recession. Hopefully it's a short one, not a deep one. And how would it further impact the Bay Area housing market? Or
Very
do
good
you think
question.
we are bottom already? Yeah, because you mentioned a few times.
Very good questions. And let me move to that chart right there. It's actually about, business leaders, about a slide about the CEO. So CEO, about 85%, it's right here. About 85, 86% of the CEOs actually believe that we will be going into recessions in the next 12 to 18 months. Now, this is, again, a national level. So as I mentioned, the tech sectors, the Bay Area sectors, they actually may be a little bit big. They probably got hit a little bit sooner, partly because, well, as I mentioned, the stock market has been fluctuating, and also at the same time, the work from home era may be actually not as sustainable as as many people think. I'm still working from home, but a lot of people may be going back to the office or so. So the tech sectors actually probably get hit a little sooner than other part of the economy. So in the Bay Area, with a lot of tech sectors or tech companies, we are actually seeing or treating some of these tech companies, business leaders, as the leading indicator. I think the Bay Area probably will pull out from from the economic recessions, or pull out from market recessions a little sooner. Now, as of this point, as I mentioned, we still expect a mild recessions in the Bay Area. There will be some cost cutting, and it's already happening. But keep in mind, though, Bay Area has always been an area or a housing market that has very, very tight in inventory. It continued to be tight in terms of inventory, partly because of not being able to build as many homes. Now, of course, we now have people who can work from home also, so that could actually lead to a little bit more migration to some of the more affordable areas like Napa, Solano, and Sonoma. But overall, I think even though there might be some layoffs, the job numbers suggest that things are actually still doing okay. We are going to see more people getting laid off, but hopefully, that will actually weather it out a little bit. And I think, again, Bay Area probably will see a faster pullout compared to the state as a whole, partly because if you look at the stock market, if you look at the financial market, things seem to stabilize a little bit more compared to, say, 6 months ago. This is also a suggestion that, of course, that is actually tied in with some of the tech companies as well. That actually suggests that things actually could be moving forward, even though it's moving at a slow pace. It might be moving forward a little bit more this year and next year. I would not be. I wouldn't. I don't want to. I will not. I will be lying to you if I say things will be completely okay before the end of the year. I would tell you that things actually will continue to be a little slow in terms of sales. Price actually will dip a little bit before we pull out, maybe in May or June. That will actually start stabilizing. And that might be a good time for many buyers and sellers to get back into the market. But even before then, I always suggest, if a buyer is interested in a property, purchase it first. The rates probably will come down a little later. Then you can always refinance.
Yes, totally agree. Especially Bay Area, there's always a very tight supply of housing. And then there are continuous pool of buyers, either, young family or the people moving in the area.
Right.
Again, very much. Thank you very much for the time. Appreciate that. And thank you everyone for attending. So it's a very good presentation, and then we're going to record, send out the recording and the PDF file to everyone that attended.